and welcome to today's lecture on IAS 40 investment property. In this video, we will cover IAS 40 investment property. This standard is important because many exam mistakes happen when students confuse property with property, plant and equipment and inventory, which lead to wrong measurement and profit figures. So by the end of this lecture, you will be confidently classify investment property and apply the correct accounting treatment. Okay, let's start with our agenda. So in our today's lecture, I will be covering the definition related to IS 40, the scope, like what it covers, what it excludes, the core rules, which includes recognition, measurement, presentation, disclosures, and the step-by-step framework, one short and simple example, common mistakes, and key takeaways. Okay, now we have a definition of IS 40. Investment property is land or building held to earn rentals or for capital appreciation, not for own use or sale. So it is very clear from the definition that uh, what type of property will be recorded in IS 40. One which is used for rentals, like to earn rent to give to your tenants, let out to your tenants, and for capital appreciation. Here, what does capital appreciation means? Capital appreciation is the increase in the market value of an asset over time, not through rental income but through price growth. And the property that is used for own use and for sale will not be included in IS 40. Okay, it will be discussed further. Now we have a scope of IS 40, like what it includes and what it excludes. So the property rented out under operating lease will be treated in IS 40. Land held for long-term value increase will be treated under IS 40, and building lease out to tenants that we earlier discussed, like rentals earned from them, will be treated under IS 40. What need to not included in IS 40 is owner occupied property. It needs to include it under IS 16. Property held for sale will not be recorded in IS 40. It will be recorded in IS 2, inventory. Property under construction for own use will also exclude from IS 40, and it will be recorded under IS 16. So it is all about the scope of the IS 40. Now, here we have the recognition criteria. Investment property is recognized when future economic benefit are probable. What does it mean? Like 50%. There's a 50%, more than 50% chances that our asset will bring future economic benefit, and cost can be measured reliably. Okay, reliably means reasonable. There is reasonable accuracy, objective and verifiable evidence. Now we have the measurement. Now, how we will measure our investment property? Initially, we have like initially measurement and subsequent measurement. Initially, we measured our investment property at cost. So the cost includes purchase price, legal fees, professional fees, and directly attributable costs. Subsequently, we have two models, and it's your choice what model you want to choose. We have a fair value model and cost model. Okay, let me just show you. Yeah, as I discussed earlier, initially we will measure our investment property at cost, recording the purchase price and transaction cost, and we will get our carrying value, right? Subsequently, we have two model, cost model and fair value model. In our cost model, we will just easily deduct our depreciation and impairment, and we will get our carrying value. In a fair value model, we will record our our property at a fair value, and any gain and loss will be transferred to statement of profit and loss. In a fair value model, there will no we will not charge any depreciation. how it will be presented in financial statements. So for the depreciation and for the okay, so how it will be presented, the carrying value and the fair value will be presented under a non-current asset section in SOFP as investment property, and the depreciation and gain on loss will be presented in statement of profit and loss. Okay, we have another concept of transfer in IS 40, change in use. Transfers are made only when there is a change in use. Like if we want to transfer our property from owner occupied to investment property to inventory, and investment property to owner occupied. Okay, here we have three scenarios. In our first scenario, if we want to transfer our property from I-16 to I-40 using cost model, we will just simply transfer the carrying value from I-16 to I-40. In our second scenario, if we want to transfer our property from I-16 to I-40 using fair value model, we first need to bring our property value to fair value. Like here, first of all, we deduct the depreciation, impairment. Now we have our carrying value. We find the gain and loss. Such gain and loss will be recorded in SOPL, statement of profit and loss. Now that amount, the revalue amount, will be transferred to fair value model, investment property. And here we will just record it as a fair value. We will find here the carrying value, carrying down fair value, and now here no depreciation will be charged. And the gain and loss will be transferred to statement of profit and loss, same as I-16 cost model. In our third scenario, if we want to transfer our property from I-40 to I-16 using fair value model, okay, we will just transfer the fair value amount here to I-16, but now we will charge depreciation here. Like depreciation will be charged here, the impairment will be charged here, and we will calculate our carrying value in this manner. So this is a concept of the transfer in IS 40. Now, how to be recognized and investment property is removed or de-recognized when it is sold or it is permanently withdrawn from use. How the gain and loss will be calculated? Deducting the carrying value from the sales proceed. The disclosure requirement includes measurement model used, fair value of investment property, rental income, direct operating expenses, reconciliation of carrying amount, opening and closing. Here we have the basic framework of IAS 40 investment property. It includes identify the property type, check the purpose of holding, apply recognition criteria, measurement at cost initially, use fair value or cost model, recognize, record gain and loss correctly, present under non-current asset, make required disclosures. Okay, here, so let me explain a very simple example related to IS 40. Here we have a example, simple example. ABC Limited purchased a building on 1 January X1 for 10 million. The building is rented out to tenant under an operating lease. At 31st December, the fair value of the building is 10.8 million. So for IS 40 investment property, what we need to do first of all, here we need to identify the property, whether it is used for rental or capital appreciation or for another use. If it is used for rental or capital appreciation, then we will record it as and recognize in IS 40 investment property. Okay, it is clearly mentioned in the example that the property is rented out to tenant, so it will be recorded under IS 40 investment property. Okay. Second thing which we need to do is its recognition. Initially, we know that investment property is recognized at cost. And how we will pass our journal entry? We will debit the investment property and credit the cash and bank with a 10 million amount. Yeah, we mentioned in our question. Okay, third step is subsequent measurement. So the XYZ company is adopting the value model for subsequent measurement. We will record the our property at 10.8 million at the year end, and at the start of year it have a carrying value of 10 million. Now we got the fair value gain of 8 lakh. Such gain will be treated as treated and recorded in profit and loss. How the general entry will be passed for this? We will debit the investment property with the 8 lakh amount and credit the gain and loss in a P&L with the 8 lakh amount. Last step, how it will be presented in a financial statement. We will we will record the investment property in non-current asset section as 10.8 million, and in the P&L we will record the fair value gain with the 8 lakh amount. Okay, it's a very simple example. Now let's discuss some common mistakes related to IAS 40, confusing IAS 16 and IAS 40, forgetting that fair value gain go to profit and loss, treating owner occupied property as investment property, forgetting to disclose fair value under cost model. Now we have a quick recap of IAS 40. IAS 40 apply to property held to earn rent or capital appreciation. Fair value gain and losses go directly to profit and loss. Classification depend upon use, not ownership. So thank you. That's all for today's video, and thank you for your time.